Global stock markets have witnessed a significant decline, sending shockwaves through the financial world. The Dow Jones Industrial Average experienced a dramatic drop of over 1,000 points. This downturn has sparked concerns among investors and economists, raising questions about the health of the global economy. Major indices across Europe and Asia also experienced substantial losses. This sell-off can be attributed to fears of a recession, rising inflation, and geopolitical uncertainty. Central banks are under pressure to address rising inflation, exacerbated by supply chain disruptions and increased energy prices. The IMF has downgraded its growth forecast for 2022, warning of a confluence of shocks.
The sharp decline in stock markets reflects growing concerns about the global economic outlook. Several economic indicators have raised red flags, fueling fears of a recession. The manufacturing sector has shown signs of weakness, with Purchasing Managers' Index readings declining. Inflation remains a major concern, with consumer prices rising at their fastest pace in decades. The ongoing war in Ukraine has further exacerbated inflationary pressures. Central banks face the challenge of taming inflation without stifling economic growth. Fear and uncertainty have gripped financial markets, leading to a flight to safety. Investors are selling off riskier assets and moving their money into safer havens, contributing to the decline in stock prices.
The U.S. Federal Reserve plays a crucial role in shaping monetary policy and influencing market sentiment. In response to rising inflation, the Fed has begun raising interest rates and is expected to continue. The goal is to cool down the economy and bring inflation under control. However, there are concerns that the Fed's actions could slow down the economy too much. The Fed's decisions on interest rates have a ripple effect throughout the global economy. Higher interest rates in the U.S. can lead to capital flight from emerging markets. The Fed has also begun reducing its holdings of Treasury bonds and mortgage-backed securities. Quantitative tightening is intended to curb inflation but carries the risk of slowing down economic growth.
The turmoil in U.S. stock markets has reverberated across the globe, with major indices in Europe and Asia also experiencing significant declines. The interconnectedness of global financial markets means that economic shocks in one region can quickly spread to others. The decline in U.S. stock prices has dampened investor sentiment globally, leading to a sell-off in other markets. The economic slowdown in China has also contributed to the global market downturn. China's economy has been impacted by strict COVID-19 lockdowns, a property market downturn, and weak consumer spending. The war in Ukraine has added another layer of uncertainty to the global economic outlook. The IMF has downgraded its global growth forecast for 2022, citing the war in Ukraine as a key factor.
The cryptocurrency market has also been caught up in the global market downturn. Bitcoin has lost more than half of its value since reaching an all-time high in November 2021. Other cryptocurrencies have suffered even steeper declines. The decline in cryptocurrency prices can be attributed to overall risk-off sentiment, concerns about regulation, and the collapse of several high-profile projects. Despite the downturn, the cryptocurrency market remains highly volatile and unpredictable. The long-term outlook for cryptocurrencies remains uncertain, and investors should proceed with caution.
The recent market volatility serves as a reminder of the importance of diversification, risk management, and a long-term investment horizon. Investors should avoid making impulsive decisions based on short-term market fluctuations. Panic selling often leads to regret, as investors may miss out on potential rebounds. During periods of market uncertainty, it is essential to have a well-defined investment strategy and to stick to it. Investors should review their portfolios to ensure they are appropriately diversified across different asset classes. Diversification can help mitigate losses by spreading risk across different investments. Investors should also consider their risk tolerance when making investment decisions. Seeking guidance from a financial advisor can be beneficial in navigating periods of market uncertainty and making informed investment decisions.